Hello and welcome to Sectors Up Close. I'm Emma McCarthy. Our guest is Amy Kong, the Chief Investment Officer at Barratt Asset Management, and the sector that she's chosen to highlight for us today is microcap stocks. While Wall Street continues to gyrate over fears of rising inflation and the end of central bank bond buying, there has been a quiet surge in the price of microcap stocks. Sitting between small caps and nano caps, microcaps have traditionally been defined as listed companies with market capitalizations of between $50 and $300 million. One way to track them is the Russell Microcap Index. It has risen 28% so far this year, so more than double the rate of growth in the S&P 500. The recent surge in the shares of companies that make up this index, which also includes the likes of GameStop, has resulted in the average market cap of companies in this index ballooning to $1.3 billion. Stocks in this index still make up only a tiny fraction of the wider market. Well, for more on this, I'm now joined by Barratt Asset Management's Amy Kong. Amy, thank you for joining us. Why have microcaps done so well, and why should investors be looking at them?
Hi, thanks for having me. I think microcaps, small caps in general, fall under the broad concept that equities as a general asset class has proven to be a reliable hedge against inflation through time. As we know, the market cap runs from nano-cap, to your point, all the way up to mega caps. And on the larger end, you've got companies that have brand reputation and the competitive positioning to pass on larger input costs to their consumers and to just raise prices in general. They may also have better balance sheets to maintain the dividend or return of capital back to shareholders. On the nano side, or even the microcap side, as we're highlighting today, they don't have pricing power, but they have flexibility. And that nimbleness has helped them manage through the way they operate, the way they control their expenses. In general, these are early stage companies. And so if successful, the return, the reward for these companies should and has proven to more than offset the opposite cohort of companies that typically fail in the same space. And that has proven to be the case over a very long history. In fact, if you look at microcaps, small caps too, but microcaps in particular, this sub-asset class has outpaced inflation every decade since the 1930s. So really for the past 9 decades, this microcap subset has proven to outpace inflation, which is obviously an interesting statistic that we are now digesting.
So let's talk then about risks. Of course, volatility, and there's a huge number of companies to choose from. So is this best left to the professionals?
I would say for a professional or even a retail investor, it's important to keep in mind that volatility. And as you know, even a professional investor, we try to gain access to this asset class through a pooled strategy as opposed to trying to pick the winners. Ultimately, I think that is the best way to allocate this particular asset class into a portfolio. The volatility is important to note. It generally is about 20, maybe 25% higher in terms of standard deviation over a large cap asset class. And so what we try to do at Barratt, and most institutional investors as well, is recognize that this is a complementary asset class, and it really should have a higher risk profile, but at the same time, a higher return profile to complement a larger core portfolio. With regards to the fact that these are small companies and there are not a lot of analysts covering these names, yes, that is a concern, but I'm not as worried about that, again, because we are approaching this in a pooled investment perspective. And also, I actually think that having fewer analysts on these names helps put a lid to an extent on the volatility, because there's just less criticism on a quarter over quarter basis. And I think most investors approach this asset class knowing that it's really the performance of the entire cohort over a phase of a business cycle as opposed to every quarter.
So let's talk, of course, now about GameStop and these other meme stocks. So as companies with smaller market caps are vulnerable to market manipulation, does this change your outlook?
It is definitely something we're paying attention to. The Reddit muscle, as I call it, is stronger than most have expected and is likely to stay longer than expected. And so I think it is a game changer in the sense that there will be more attention on some of these names. What you will probably find is more volatility, But so far, we have seen it more volatility to the upside than to the downside. And that may help, again, reinforce that this asset class could maintain its track record of outpacing inflation through time. I do think that, even if GameStop is not the hot stock of the week or the flavor of the month, if you would, that attention may just rotate to another stock within the same category. And so what you may find is just a more frequent rotation of the top 10 names per se. But I think ultimately, at the end of the day, it's likely to add to volatility. But at this point, it's not something that I'm too concerned about, but it's certainly something that I'm watching.
And finally, Amy, how would you invest in the sector?
As mentioned, it would be best, in my perspective, to really approach this in a diversified, pooled investment strategy. It is very difficult to really keep track of all, the thousands of companies in this space. And so the way to approach this is really through most easiest, it would be the ETF route. I think we can all agree that there are tons of ETFs to choose from plain vanilla small cap ETFs to very specific ETFs that, there are microcap ETFs in particular. I've also seen fancier structures, if you would, where you can actually now find small cap, low volatility ETFs floating around. And what does that mean? It basically is taking an index like the S&P 600 and really thinking through the 25% of that index that have demonstrated the lowest volatility over the last 12 months. And so those types of indices, unfortunately, have not outpaced the general small cap index. And they're also higher fees, meaning they're about 25, maybe 30 basis points versus the very plain vanilla small cap index at about 5 basis points. And so my perspective, it's likely to be the easiest route to just choose the plain vanilla small cap ETF. And again, watch the entire group hopefully outperform over this phase of the economic recovery.
Thank you so much, Amy Kong, the Chief Investment Officer at Barratt Asset Management. Before I go, I wanted to update you on the main story affecting this sector, and that's the return of the so-called Reddit rally, which has seen retail investors pile into the shares of companies such as AMC Entertainment, GameStop, BlackBerry, and recently Bed Bath & Beyond. AMC announced Thursday it may issue another 11.5 million shares, only days after it sold 8.5 million to hedge fund Mudrick Capital, which then flipped them on the open market for a profit. In announcing the latest share issue, AMC also made this extraordinary statement, quote, "Under the circumstances, we caution you against investing in our Class A common stock, unless you are prepared to incur the risk of losing all or a substantial portion of your investment," end quote. CEO Adam Aron seemingly encouraged the rally on Wednesday when he announced an initiative that offered even the smallest shareholder a free large popcorn if they signed up for a regular newsletter. Well, that's your look at the microcap sector. I'm Emma McCarthy, and this is Reuters.